Hi, I'm Isan Tai. I head the Asia investment activities for Hermes GPE, which is a UK headquartered multi-pension fund manager. So we invest in private equity. We've got about 10 billion under management. About 20% of that is invested in Asia, and we're focused on both primary fund investing as well as co-investing.
Good morning, Iris Zhao. Pleasure to be here. I'm with GCM Grosvenor. I look after our venture and growth investment activities as well as head Asia private equity investment activities.
Good morning, everybody. I'm Jacob Chiu. I work for HQ Capital, a global alternative asset management firm owned by the German Quant family. So we do both real estate and private equity. On private equity side, so we do primary fund commitment, we do secondary interest purchases, and also co-investment. So I'm more on Asian primary fund and also co-investment. Thank you.
I'm Richard Kunzer. I'm a partner at BC Partners and the co-head of the investor relations team. I've been at BC for about 10 years now and work very closely with all of our investors across the region. BC Partners has been around for 33 years now, and traditionally a pan-European buyout firm. We now invest across private credit and also European real estate.
Great, thank you all. So Richard, if we can start with you. Are the LP-GP relationships in Asia any different to those that we might see in more mature markets such as Europe or the States?
It's a very good question. I think if you'd asked me, so I've been at BC, as I said, 10 years now, and really working very closely with investors here for the last 10 years. We raised our 9th fund 10 years ago, so it's quite a good timeline. I think 10 years ago it was very different, and I think we'll come to that later. I would say investors here are the same as investors anywhere that I come across the US, Canada, Europe. They're very focused on the same issues. They've got the same concerns. I think the relationship is, there's certain hot button topics that people have, but it's a very good relationship, so it's very close. I think the hardest thing we've found, to be totally honest, with the relationships has been the turnover at the LPs amongst the investment teams. We've got investors, we have worked with the same people for 20 plus years. In some, I wouldn't say this is all over Asia, but some countries, some organizations, there's a sort of almost a 2-year turnover period, which makes it very hard in the private equity industry to really get a strong partnership going.
Isan, how about you?
Yeah, I guess I can speak from a perspective as an LP that has an Asia presence here, but headquartered in UK as well, as we fundraise as well across Asia. I think maybe if I speak first on behalf of the latter, I would say fundraising across Asia, we have noticed a similar trend where the churn has been quite high. I think, call it 10 years ago when the market was just opening up, you're sort of an educational phase, kind of bringing a lot of the pension managers up to speed about private equity. And then the first, least path to resistance is going with the brand names. And what we have noticed is some churn where they're, you've gone through version 1.0 and they're going to through version 2.0 and 3.0 and refining those relationships and churning where they're unhappy. This is less, we see that a lot less in in Europe, to some extent also in the US. In Europe, for example, our relationships are much longer and there's a lot of hesitation to churn. And whereas in Asia, it's, I think because managers are still establishing themselves, there's been openings where it's more accepted for an LP to say, well, let me sit this one out, perhaps we can revisit. Whereas in Europe, that could be the last time where you'd be able to have an opening of a particular fund. So I think the nature of that relationship is different. The other thing I would observe is outside of a brand, a lot of the Asian LPs, they do want to get to know you as an individual, which brings a whole host of challenges when there's a lot of turnover. I think that kind of frequent contact is just getting that familiarity and level of comfort is very important for them. And to some extent, a lot of them are very high-touch clients. So we do see requests, for example, for more, kind of training or educational purposes. They do want someone local, a local touch point as well. So all that we see.
So Iris, you've spent time both in Hong Kong and New York. What are your thoughts here?
Yeah, we're in a global alternative investments firm, so I've worked with GPs as well as LPs in U.S. as well as in Asia. I'd echo the point on the team turnover at the organizational level. In addition, I would say the composition of the LP base in Asia seems to be a little bit less diverse. So we do see a lot of sovereign wealth funds, very active. Certainly a couple here in Singapore, but all over Asia. Because of regulatory reasons, I think not all type of institutional investors can invest. And whereas in the U.S. or developed markets in North America and Europe, we do see a much more diverse range of institutional investors. And so because of that, I think I've seen a little bit more of a focus on some strategic angles in LP GP relationships in terms of making an investment decision or building a relationship. For example, something focused specifically on the sectors that a particular LP wants to dive deeper into, perhaps co-investing for deal flow or certain other type of kind of strategic drive for making that relationship.
Great, thank you. Jacob, in Asia we're seeing a lot of wealth and liquidity in the market. Is that been translated with investors allocating more to private equity?
Thank you. In particular, in this couple of years, the public market is really very volatile, and then we see a lot of investors. They see that private equity or alternative investment is a way that is for long-term return. So I see that a lot of them allocate more capital onto that. But I would look at it from two fronts. One is more on the large institutions, and the other is more on the high net worth and also family offices. For the institution, we see that they tend to be quite safe, and then try to commit to those big names. So that give some of the medium size or small size quite difficult to access to those big institutions. So I think that would take some time for them to really get comfortable to those medium size or small size players in the market. But on the other end, it's more on the high net worth individual and also small family office. So they feel that they want to get into the private equity, but they still some of them not get comfort on the duration, because by nature it would take at least something like 5 years, 7 years to get back your capital and then to get the return. So again, this would take time for them to get comfortable to deploy more capital into the alternatives. So this is my observation.
Thank you. Yi-San?
I think from our perspective, we definitely see a lot more allocation towards private equity, particularly from Korea and Japan. Korea in particular, I think they have already backed a large number of names. I think they have, so to say, put money where their mouth is. They have intended to do so, and they really have shown that interest over the last few years. I think they've come up the curve very quickly in terms of understanding the manager landscape. I think outside of that, I think I agree with Paul's observation that the high net worth and sort of the private private wealth has been very keen to allocate more to private equity in Asia, within Asia, for example, as well. So I think in some instances they have gone, as a strategic angle first, in backing a number of funds, and then increasingly they have sought to grow a little bit more directly, depending on the level of sophistication, but we've seen that as well.
I'd say a few things. There's been increasingly a lot more inter-regional interest that I've seen. So, maybe 10, 15 years ago, a lot of, at least from what I've seen, the interest investing to Asia are coming out of places outside of Asia. I think Singapore is certainly an exception because we have some of very long-term, sophisticated institutional investors here. But in many other markets, it's in the past, I'd say a decade or so, I've seen much more of an increased interest in investing in the region. Just the last couple of days when I was here meeting with managers, I've heard a lot of talks about Korean institutional investors, Japanese investors making investments in the region and very actively doing so. So that's one point. The other one is, I'd say, a very strong interest in doing deals. Now, when we talk to GPs, they would say that all the LPs will go to them and say, we want to do co-investments, we want to do deals. The level of experience and execution speed, I think, will vary quite a lot when they actually do show deals. But it is certainly a trend where we're seeing very strong level of interest in getting exposure directly into deals alongside the GPs.
I think that's a very good point you raised on the co-investment side of things. So alongside our buyout fund, we're probably one of the most active sort of co-investment partnerships that's in the industry. In the last 10 years, we've done about 6 billion euros of equity co-invest alongside our funds. And I think it's a very good point on the co-invest side. We see a lot of interest in the region, almost more than elsewhere in the world, on co-invest and direct investing. But it's a very interesting point that different institutions are at different levels. And I think 10 years ago, there was a lot of interest in co-investing, but the number of people who actually could do co-invest was relatively limited compared to today, where there are investors in the region who we will, quite easily go to before we've even signed a deal on the co-underwriting side of things for very large checks, whose deal teams will work alongside us. And we think it's great. It's a win-win for everyone in that partnership. I think the other thing that we've seen is now, compared to the past few years, people are taking I would say, more approach like some of the US endowments, where the amount of alternatives across their portfolio is increasing. I was meeting with an LP yesterday who said that they're presently at about 15% in alternatives, 15, and in the next year they're going to 50, which is very similar to the Yales and the Harvards of the world. So I think as the sophistication and actually the level of comfort with alternatives increases, you're going to see a big shift into that. You'll see a shift into private credit and more other alternative strategies.
Great, thank you. There was a question that was raised at one of the panels yesterday asking panelists to look 10 years into the future and give predictions. I'm not going to go down that route, but I think it would be interesting to hear your thoughts, just following up on what Richard said in relation to how LP investing and allocating patterns have evolved over the last 10 years.
I guess I think that in terms of private equity, it'll continue to perform well, I think, relative to other asset classes. I do think in the kind of recent vintages, you will see overall returns be lower than in the past, evidenced by a lot of excess liquidity, very high valuations. That being said, relative to other asset classes, I think it will still continue to perform. I think if you were to look at the asset class kind of another 10 years from now, I think what we clearly see is bifurcation of the managers, right? So larger managers having a lot easier raises, smaller managers struggling quite a bit. I think what you'll see from the LP landscape is I think you'll see the continuation of that, where some of the LPs have carved out a niche in the larger market. Others will be more apt to do emerging managers, lower mid-market type of deals. So I think in terms of allocation to Hevra, that it will continue to do well. It's always outperformed sort of public markets. We've looked at a lot of benchmarks over the last 10 years. I think it'll continue to do so. Within Asia, you'll see, I think there is also similar bifurcation in terms of returns, right? So there's a lot more ghost funds where the difference between the top quartile and lower quartile is a lot more than other markets, and that will likely continue as well.
I think it's nice to see Asian private equity kind of now taking form as its own investment strategy. I feel like, maybe 10, 15 years ago, people look at Asia and there's kind of some sporadic investment here and there, and the LP base is very bifurcated. So there are some sophisticated and progressive investors who've been in Asia for a long time and have a significant allocation to the region. But by and large, my experience has been, the large institutional investors, outside of a few exceptions, have been really not consistently looked at Asian private equity as a true investment strategy until more recent years. And a big reason for that is just, there's a lot of hype and promises of strong growth, and you do see a lot of growth in the region, but there's also so much macro volatility, so much headlines, so much external factors that doesn't necessarily hasn't translated into the kind of DPIs and the returns that we all investors want to see on a consistent basis. But I think in more recent years, we've now seen the establishment of a much more mature ecosystem where, because of the sophistication of institutional investors as well as just the market overall, you're no longer just dependent on the volatile IPO market. You have a real M&A market. You have a real base of strategic buyers who can provide a more steady state of an exit environment. So that's, I think, a development of the market as well as kind of a trend looking outward that I feel, that I take comfort in, I feel very positive on.
Richard, how about you? Sorry, Jacob.
For us, we typically allocate capital on a size of the market, private equity size of the market. So 10 years ago, Asian account roughly about 5% of the global private equity market. So we allocate roughly about that, but currently Asian account for between 10 to 15%. So we got a lot more capital to deploy in Asia. This is one. And then two is 10 years ago when we deploy capital in private equity, most of the fund are growth. So there are some buyout, but the market is not ready for that, and also for some VC. But today we see a lot of choices now in the market with buyout opportunities, and also with VCs very, very active in this part of the world. So in terms of allocation, there would be a lot more choices rather than in the past. It's just concentrate on growth capital. And as I echo on our panelists also mentioned that 10 years ago, a lot of funds they still in this fund one, fund two, not really a lot of track record that you could look at. And then at that time we look at a lot of international name, and all regional fund to cover Asia, versus now really a lot of track record that we could look at and see who would be the future top quartile manager in the market, and then we mostly look at all these criteria for deploying our capital.
Thank you. Richard, so if we look at this from an Asian context now, taking into consideration how we've seen the last 10 years evolve, what would you consider that makes an outstanding fund manager?
Well, just talking in the context of somebody like ourselves, where we don't invest in Asia, and we're investing in Europe and North America. I think there are a couple of things that come up frequently when we're talking to LPs in the region. And 25% of our capital actually comes from Asian LPs. So we have a lot of LPs across many different countries here. I would say, headline risk is actually a very interesting one. and I think it's developed, and it goes to what we were just saying about the development over the past 10 years. 10 years ago, there was a lot of focus on brand names. It was the classic, you buy IBM, you're not going to get into trouble type of scenario. Now people are obviously going to more niche strategies, sector strategies, and so forth. But there's still a big view on headline risk and downside protection, just not losing money. We see that especially in, not just in private equity, but private credit and real estate. One of the questions I always get at the moment is, I've lived in the US 15 years, but because I'm British, everyone always asks me about Brexit. What's the downside? What's going to happen? If I knew, I would not be sitting here now. I'd be on a big yacht somewhere. I don't think anyone knows. But that's a very good question, because LPs don't want to make a commitment to a fund or to a region where you've got political instability. And I think there's a much more of a focus on that here than there is in North America. I think there's just the market and I think experience of just, again, going back to the headline risk or downside. So, if it's a GP can provide, good, obviously great track record, but good steady returns, no volatility. And I think what people are looking for in outstanding GP investors here is there's so much opportunity that people can do directly in the Asian market, that when you're looking outside of Asia, you've got to be really looking for top managers, because the translation of all of the factors I mentioned, you've got to achieve a higher return to justify going outside the region.
Thank you very much. Jacob, what are your thoughts here?
For us, the ultimate aim is to get good returns. So we want to look at the manager. They deliver consistent return in terms of their valuation, and also more important is more DPI. They distribute capital back, exit and distribute capital back to us, and also more stable team. And Richard talked about the turnover. So because if the GP if they have high turnover, so it would be very difficult to justify to LP and saying that those track record are done by those existing team. So these are all what we would consider as a good GP.
Iris?
Yes, so I won't kind of beat the return things to death, 'cause I completely agree. I would supplement by saying we look at also the quality of return. So the return itself is absolutely very important. But what is that return comprised of? Is it a one-hit wonder? Is it repeatable in the next 4 to 5 years? And so we kind of look deep into the track record, kind of dissect it, pull it apart, figure out whether it's something that we feel confident that this manager can execute on in the next fund. That's another important point. And then I would add, outside of the quantitative aspect of looking at a manager, just the level, because of a lot of the perceived challenges that we're hearing LPs are talking about with the region, the volatility, the emerging part of the market, etc. Transparency and communication with the GP is absolutely critical. I find that often, it's not that the GP is not willing to share the information, but sometimes they have a hard time kind of understanding what kind of information the LPs are looking for, and what kind of information will be helpful to an LP in assessing a GP and monitoring a GP. So I think that's an area that's still developing among the landscape here with respect to us evaluating the GPs as well as building relationship and monitoring.
Yeah, so I think what makes an excellent fund manager in Asia is obviously quite different from the States. I've observed, for example, some of my colleagues who have been seconded here, and when they run a meeting with a manager, they like to go directly to the portfolio companies and ask, what did you do here? How did you add value? And then they'll come back and ask me, why did this manager spend so much time talking about their background? And I think for us, that's the difference. I think obviously in developed markets, which are a lot more buyout focused, you focus more on the value add and how has manager really add value to operations. Whereas here, that is it's a nascent area, and we really one of the key questions we look at is deal access and operational due diligence really. So is that person and a team have some angle in a certain industry sector where they're able to access deals at a very reasonable valuation, given the market is a lot more inefficient, I think, in Asia when it comes to something trading and promoters are willing to go to certain buyers for reasons that are outside of price. The other would be the diligence factor, which is that I think, as we said, the bifurcation of the returns is a lot higher in emerging markets between top quartile and lower quartile, and that can oftentimes be explained by the type of diligence and level of diligence done through a very wide variety. I think the type of diligence in Asia is a lot more different, right? You can engage a lot of third-party managers to help you with diligence, but end up with something that ends up being completely written off for a reason relating to other kind of headline risks, as we've discussed, fraud, certain other issues. So I think those are the things that differentiate for us a good manager here.
Thank you very much. I think we just have a couple of minutes left. If anyone in the crowd has any questions to ask any of the panelists. Okay, let's wrap it up there. Thank you very much. If you could join me in giving the panelists a warm round of applause, please.